Michael, let's talk a little bit about tax loss harvesting. What is tax loss harvesting on its surface? What are we talking about here?
So the essence of tax loss harvesting is a situation where I've got an investment, it's lost some value. The reality is if I sold it, I would get a deductible tax loss. Okay. But I don't actually want to sell it, or at least I don't want to eliminate it from my portfolio. I kind of want to hold on to it. Maybe I'm hoping it's going to rebound, or I've got other constraints. So I want my tax loss, but I don't want to actually change my investment position, at least not for the long run. So I'm trying to figure out how do I, kind of literally speaking, harvest the loss without substantially changing my long-term economic position. That's what we're shooting for with tax loss harvesting.
Okay, so I'm trying to kind of tax loss harvest, sell a little bit here, a little bit there, can come up with a taxable loss. How much do I get to deduct? What do I deduct that against?
The opportunity here is if I sell an investment at a loss, like I get the loss. I get the loss like any other capital loss. It'll be long-term or short-term depending on the holding period. If my net losses exceed my gains, then I get a $3,000 loss against ordinary income, and then the remainder is carried forward. So my loss rules still exist as they normally would. The constraints, though, is the IRS takes a hard look at how you actually sold the investment, how long you were out of it, because obviously in the logical extreme, they say, wait, let me get this straight. I can just, today's market with ETFs, I'm going to sell an investment, I'm going to buy it back 2.3 seconds later. I'm basically never out of the market, and I just get free tax deductions. That's a little problematic.